Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to break down a couple ETFs that were recommended in the comment section down below. VEQT and I think it is XEQT that were down there. So there are two ETFs that I'll take a look at. Honestly, I am biased when it comes to ETFs, just so you know. Please, if you get triggered by this video, please understand that everyone has their own investing strategy, their own opinions when it comes to investing. Not everyone invests the same. So if you're new to like this stuff, please take my opinion with a grain of salt, and of course do your research. And so if you're new to the channel, welcome. This is where you put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So as we usually do, we give you an update on the portfolio here. So we'll go ahead and do that. The portfolio today closed out at $10,924.67. We are down $183.05, down 1.65%. For the 1 week, we are up $24.12, up a whopping 0.22%. For the 1 month, we are down $327.56, down 2.91%. For 3 months, we're up $236.18, up 2.21%. For the 1 year, we are up $1,479, up 15.66%. And for the all, we are up $2,059.51, up 23.23%. And so that is the portfolio. We're going to go ahead and open a reward here. So there's a lot here. But Moish, I did open yours. So we did get $5.12 from you. It was from Microvision. And then I had a little glitch, but you seem to have another one. But Mikhail, we'll go ahead and open yours. Remember, you'll earn cash value of 3 stocks instead of 1 when you invite your friends to fund their trade account. This goes until March 24th. So there is a referral link down below if you want to use that to get your 3 free stocks once you fund your account. So Mikhail, thank you for using that referral link down below, and go ahead and claim that. And boom, did it work? There it is. Lumen Technologies Inc. coming at $13.43, Nikola Corporation $8.45, and Canopy Growth Corporation at $8.03. We'll deposit that reward. We're going to look at VEQT. And again, please understand that this is totally my opinion, and I'm probably biased. But the only 2 ETFs that I own are, the only 2 that I personally own are VFV, so the S&P 500 index, and then also the NASDAQ QQQ, which is actually in American, I do believe, but not in this portfolio that we show on the channel. So VEQT, which is the all equity ETF portfolio with Vanguard, we'll break it down here. So currently it sits at a price of $34 roughly, and the management fee is 0.22%. I don't know what it's managing, so we'll just go through it. MER is 0.24%. So to give you context on that, for every $10,000 that you have invested in this, it's going to cost you about $24 to have that. So you will have to pay that. So what is this? This is a all equity ETF. So from what my understanding is about all equity is that it is all stocks in a sense. Okay. Doesn't look like it's had a bad performance cumulatively. Let's see your market price, 45% gain since inception. Looks like, so not bad. Summary there, monthly. Let's take a look at a monthly here. Okay. Annually is probably what we want to look at. 2021, not bad, 19.59%. So about 9% behind the S&P 500. And that's what I'm going to compare it to, because that's what I know. In 2020, 11.29, lagged behind the S&P 500 again, because I do believe it was 14 or 16% in 2020 for the S&P 500. So this is a fairly new fund, I'd imagine, because there's no 2019 there. So 99.98% are in stocks, and the rest is in cash or short-term reserves for any movements. Number of stocks. Is that right? 13,511. Okay. So automatically I'm already not a fan of this. And the reason why is, let's see if I can pull it up here. Just think about it. 13,511 stocks in a portfolio. Who manages this? Who has the ability to manage all these companies within this book? this fund alone. So the other thing is, what I want to look for is here it is, market allocation. So 42.9% in the United States, of course, which would make sense. 30.4% in Canada, sure, makes sense. Japan at 4.4%, so the Nikkei. United Kingdom sitting at 2.8, China 2.5, emerging markets. France at 1.8, Switzerland at 1.7, Germany at 1.6, Taiwan at 1.4, and Australia at 1.3. And I'm sure there's more if we exported. Obviously, I don't want to do that for some reason. Sectors, we got 20% in finances, 18% tech. So two of my favorite sectors, and biased against that as well. 3.3 in real estate, which is interesting. And energy at 7.2. Okay, so here are somewhat of the holdings. So, okay, Apple at 2.54%, Microsoft at 2.18%, Royal Bank at 2.12%. Awesome, that's impressive. Toronto Dominion Bank, also known as TD, Shopify's in there, Amazon, Bank of Nova Scotia, Enbridge. So a lot of these companies we do know, but guaranteed I don't know the other 13,000 some companies. And it's already broken down into this kind of allocation, which is, yes, in dollar figures, a lot of money. Not gonna lie, in that portion. But I imagine the majority of this fund or this ETF is probably sitting at a 0.0000% of a position. Now, again, I'm not taking dollar figures into this. I'm just taking percentage wise and working based off that. But this 13,000 number is already throwing me off, and I don't like it. I really don't. So yeah, I'm not a fan already, because to be honest with you, if you don't know maybe the majority of the companies in there or heard of them, I don't think it's something I would want to invest in. It's for me, when I want to invest in companies I know, companies that have record of age, well, not record of age, but just a record of longevity, the ability to continually grow, but not even at a monstrous rate like 20% per year or whatever, but have established companies that can create consistent cash flow, which is fine for me. But 13,000 holdings, could you imagine owning 13,000 positions in your portfolio? No, not happening in my opinion. So that's the VEQT. I'm not even going to get into any more of it, but let's check out XEQT, which is the iShares Core Equity ETF portfolio with RBC. So MER here, so managed expense ratio sitting at 0.2%, which is a bit lower than the Vanguard one. I'd imagine based off of that, there's probably less holdings in this one. So again, for every $10,000 you have invested in this ETF, the management expense ratio that you'll be paying is about $20 on this. Lower market price, of course. Calendar return. Okay, so returns here 2020 11.7. I think that's better than the this one, VEQT. So 2020 was 11.29. Okay, so roughly the same. And 19.6% in 2021. Year to date, we're down 3.5%, which is pretty common across the board. Equities, we're looking at 99.9% in equities and 0.1 in cash or derivatives. Number of securities, 4. Number of underlying securities, 9,576. Okay, so again, whoever's managing this fund, have fun with that, unless there's a team doing it. But imagine, because there's 4, this is made up majority of other ETFs. Am I right? Exposure breakdown. So market, what's that? Allocation wise, 44% in the US, sure, 25% in Canada, 9.1% in other, 5.7% in Japan. Okay, holdings, here we go. So yeah, these are a lot of, these are other ETFs, I believe, that they have. Let's go to underlying holdings. Okay, so this is what I want to look at. So we know a lot of these companies, Apple, Microsoft, Royal Bank, Amazon, Enbridge, and so on and so forth. I'd imagine that the objective of this portfolio is to have as much diversification as possible, which is fine. So I'm going to go down the list here, and I'm going to see which companies I do know down to the point where I don't know them, and give you an idea of why I'm biased against this. So really quickly, No, 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 no. I know, I know, I know. Now, I'm not going dollar figure wise, as we know. It's mostly just percentages. I'm already in the part where some of these are not some companies I do know at all. I think Chubb is like a safe company, I think. 3M, as we know, Brookfield, very well-known company, multinational company for sure. So here we go. I think we're getting there. Nintendo, we all know. Deutsche Telekom, no idea. We're not even down like all the way here. Mercedes-Benz, we know. Like a lot of these, yeah, no, not doing it. Not doing it. For me, I'm not going to invest in this. It's just I think too much underlying assets can lead to too much exposure. Well, not exposure, but too much of money being allocated so much different ways. When it comes to ETFs, you're going to get some overlap, of course. I mean, you buy an ETF, I'm pretty sure most of them, if you're buying the certain ETFs, you'll have these companies in there like Apple and Microsoft, and they just overlap. Now, understand you don't buy shares in ETFs. You do buy the asset pool that the ETF provides. You get units instead of shares. And so another downside to ETFs, and I could be wrong, is, in my opinion, the illiquidity that comes with ETFs. It's harder to get rid of ETFs than it is just, regular shares of companies, because institutions will typically buy your individual shares or other investors when it comes to trading on the marketplace. ETFs are similar to mutual funds, but can be traded on the marketplace. But yeah, I'm just not a fan of the amount of shares that are in there. And I'm just not a fan of ETFs, to be honest with you. So really, there's no value in this video. I'm just going to put it out there because, yeah, just doesn't make sense to me. So we'll head back to here. Sorry, I couldn't break it down more for you. Honestly, it's not my forte, but we'll go ahead and open this from Nicholas. Claim a free stock. Works now. PG and E Corp 1426. Microvision 556. PG and Corp 1426. Total earned is 3408. Again, thank you, Nicholas, for that. And that is pretty much it for the portfolio, guys. ETFs, sorry, couldn't break it down too much for you on ETFs. Not a big fan. I only own two, which would be the S&P 500 and the NASDAQ funds. And to have 13,000 holdings is just not my thing. I can barely keep track of 20. And so, I mean, if you don't know the company, why invest in it? It's kind of like another form of gambling, and I'm just not about that. I like to really know what the numbers are for a lot of the companies that I own. And I could be, and again, I can be completely wrong when it comes to ETFs. I know a lot of people, it's a very popular way to invest. I hear about it all the time, but I'm just not the guy to really understand it. Why you'd want to hold that many holdings. I mean, just holding the S&P 500 is good enough for me, even though it's strictly just the US. Performance wise, it's fine to me, but having 13,000 is just too much. I think you're just diluting the possibilities of high returns, even though they've had a great year at 19.59%. But a percent matters in the world of investing, I guess. And that's why I still stick with just the two ETFs that I do have, or indexes. But that's pretty much it for the video, guys. I know it's probably not much there to go off of, but that's my biggest thing. As soon as I saw the 13,000, I'm out of there. As soon as I saw the 9,000 holdings, I'm out, right? Even the S&P 500 is a lot, and I know the NASDAQ has quite a bit as well, but those have requirements to be in there. It just seems like this is just, in my honest opinion, 13,000. They're just throwing things in there based on geography and allocation, and yeah, I don't know. So if you have a opinion on it, leave it in the comment section down below. I do go through them, I read them, and I'm always willing to learn more about this stuff. So on that, guys, hope you guys did enjoy the video. I know there wasn't much, but have a great week, and we'll see you in the next one. Bye.